Behind the scenes, interest rates pose an enormous threat to the stock market. You see, interest rates determine the valuation of every financial asset in the economy. If we use a standard 10-year government bond as a benchmark and compare this to the earnings yield of the S&P 500, we can see a pretty interesting pattern over long periods of time. As interest rates increase, the earnings yield of the S&P 500 increases. And as interest rates decrease, the earnings yield of the S&P 500 decreases. Which makes sense because if you can earn 10% interest from a high-yield savings account, why would you ever invest in stocks that have a 3% profit yield? In other words, over long periods of time, the market prices the opportunity cost of the risk-free interest rate into its valuation of stocks. Which brings us to the main topic of how different interest rate scenarios can directly impact you. For starters, if inflation ticks upwards, the Fed could be forced to increase interest rates, which in turn could put pressure on stock valuation multiples. On the other hand, if inflation holds steady, interest rates may need to remain where they are, which could dampen businesses as their debt comes up for refinancing. This is because higher interest rates eat into corporate profits, which can cause layoffs, which can lead to a recession. And this begs an important question. What type of assets exist that don't have tons of exposure to this interest rate risk? Long story short, high-quality companies with pricing power selling at good valuations tend to perform the best under inflationary environments and recessions. And in my free Discord, we're going to go more in depth on these topics, so follow for more.